Hello, folks. Good morning. So, Donald Trump recently announced that there'll be a 50% tariff imposition on Indian imports to the US, right? And this kind of sent shockwaves both through global macroeconomic circles as well as Indian markets. So, in today's episode, we'll be diving into two key parts here, right? One, we'll be understanding the thesis that is kind of driving this sort of an action from the US. And the second part, as investors, we obviously want to know as and when this thesis plays out, how should we position ourselves to benefit from that, right? So we'll be diving into that into the second part of this analysis as such, right? So to begin with, let us start with the people driving this, right? And while Donald Trump is the face of the tariffs, his chief economic advisors, etc., are the people who are actually kind of guiding him on this, right? And Mr. Stephen Miran, the person who is his chief economic advisor, had come out with a paper in November of 2024, right around the time kind of Trump came to power, outlining his thesis of how US should trade with the world and the current kind of fault lines that are driving that away as such, right? So the central thesis that he came up with, which is outlined in a 41-page or paper, was that because US is the world reserve currency, by default it is the currency tends to be very strong, right? And US as the reserve currency has to kind of supply this currency to other world powers for their trade, etc. And as a result of which, from an export competitive point of view, the export competitiveness of US goes down. It has to maintain a regular trade deficit to maintain its power as the reserve currency, and as a result of which, over time, its uh, trade deficit kind of keeps expanding as such, right? So that was the base that they started off with, which is also known as the Triffin paradox, right? Which is effectively when you serve as the reserve currency, by nature of that, you also have to bear a certain trade deficit as such, right? And the dilemma here is as the US contribution of global GDP comes down, right? So in the 1960s, the US contribution to global GDP was around 40%. As of today, that has come down to 26%, right? And with all likelihood, I'll kind of go down further. So as that happens, and US still has to bear the burden of being the reserve currency, their trade deficits will kind of keep expanding, and that at some point of time has a bearing on the kind of debt that the US government has to take as well. And as this cycle keeps playing out, that US contribution as a percentage of GDP goes down, but the deficit kind of keeps expanding. At some point, people will kind of lose faith in that currency and kind of detach from the currency as such. Right? We'll have a wave of de-dollarization that will happen, which is obviously not good from a US point of view, right? So those were the two kind of challenges that they faced. One is the Triffin paradox. The second is, as and when this kind of breaks out, you'll have a wave of de-dollarization happening as such, right? So what they attempt to do is, while still maintaining the power of the dollar, how can you still benefit from a greater amount of trade, right? Because obviously, if you are a exporter to the world, or even if say your deficits kind of come down a bit, you'll kind of be able to drive greater employment, etc., in your own country, which helps from a economic standpoint. More importantly, it also helps from a posturing and a political standpoint, right? Which is uh, what something like Mr. Trump would want to do as such, right? So the thesis that he had was, effectively, when you are dealing with emerging sort of countries, and they use the 2018-19 tariff imposition on China for this sort of impact, was that as you kind of took tariffs up, the kind of fear that you have is that inflation in your country will kind of go up, and as a result of that, your people will kind of suffer due to higher inflation, right? However, what they kind of observed was a bulk of the increase that had happened in the tariffs rate was actually passed through, not to kind of customers via inflation, but via depreciation in the Chinese currency, right? And as a result, the landed price that you got on a US dollar front was still the same, and the customers didn't kind of bear, your US customers didn't bear the brunt of greater inflation, However, because the Chinese currency is kind of devaluing, you're effectively taking away purchasing power from the Chinese economy as such, right? So this was their kind of way of tackling this, which is having a rise in tariffs, which generates revenue for the US Treasury. At the same time, the hit of this, the impact of this, as long as it is via a currency offset than via inflation, the hit will be more on the countries they are imposing it on, right? Countries like China, like Brazil, like India will have to kind of bear that burden, while US will not, right? And if you see the positioning of this effectively gives US the best of both worlds, right? They have the reserve currency, as a result of which they're able to finance at lower rates, they're able to get all of the benefits that come with being a reserve currency. At the same time, they don't bear the cost of being a reserve currency, right? They're effectively saying we'll get all the benefits of being the reserve currency to ourselves, and all the costs of being the reserve currency we'll pass on to our trading partners as such, right? And that is obviously the thesis that they have set out with. Uh, and obviously there will be at some point there will be some sort of a pushback on that as such, right? As we've seen kind of playing out, at least amongst the BRICS countries, and increasingly we'll see it play out in other countries as well, right? Now, once we've understood this, right, once you've understood the kind of thinking that is going behind these sorts of policy decisions, how do we as investors think about this, right? The first is all of this talk about Russian crude, importing crude from Russia, importing this from Russia, all of that goes away, right? That is just pretty much junk, to get people on the negotiating table to have something which is not even a variable, effectively a part of the negotiating discussion, so that you have more leverage, right? So, as sensible kind of trading partners, as sensible countries negotiating with the US, this should not even be a factor, right? We are a sovereign country, we can effectively trade with any country the way we want, and the US will not tell us who we can or cannot trade with, right? So that part of the equation is simply out. So if you look at a lot of the sell side reports today, they effectively said we import crude from Russia at this price, this is the global Brent rate, so we have a $2 spread, we have whatever, and if we kind of stop taking it from that will be a, right? That is effectively a moot point, right? It doesn't matter at all. We know the rationale why they're doing it, and the whole Russia factor, the Russia oil factor, is not even relevant to the discussion, right? So, firstly, that should be out of the table straight away. If you want to negotiate as two countries without kind of discussing how we are trading with other trading partners, right? Then we come to the second part of how this could kind of proceed as such, right? And because you know the rationale of the people behind the decision, which is they do not want kind of they want to maintain two things, right? One, they do not want inflation to impact their people. Second, they want to have US as the reserve currency, right? So effectively, the way you retaliate is you attack both of those, right? You know that because they do not want de-dollarization to kind of the inflation to kind of impact their customers, right? Impact their own US consumers. So you know the amount of negotiating leverage they have is limited, right? So they can say 50%, 100%, 200%. It is his kind of own Twitter channel. But effectively, you know he will come down to 10-15%, right? And irrespective of what you negotiate with, he will keep it at 10-15%, because if he is betting on currency depreciation, right? If he is betting that inflation will not be passed through to the US consumer and the hit will be passed through via a depreciation in currency, there is a limit up to which he can stretch tariffs, right? You cannot keep it at 200% and expect the currencies to kind of depreciate that much. The amount of tariffs he can apply are limited there, right? As a result of which, we know over a medium to long term, at least say if he negotiates for the next 3 months, 6 months, whatever, eventually it will come to 10-15%, right? And irrespective of what we negotiate, we do not have to give up on trade with Russia, we do not have to give up on agriculture, other things that he's kind of committing. We can still maintain our stance as is, and we know eventually he will come to 10-15%, right? So that gives us an advantage where we are kind of negotiating, knowing that he has the pain point of kind of impact to the US industry and US consumer at the center of his decision making, right? The second major factor is the de-dollarization bit, right? Obviously, a lot of countries currently hold US dollars in their reserves. And gradually, this shift has already been taking place. So, if you look at the kind of dollar reserves central banks have been taking post the Russia crisis, where the US had kind of confiscated a lot of Russian assets illegally, effectively theft, you saw central banks increasingly moving towards gold, right? So, given the actions of the US government now, that sort of a trajectory, that sort of a shift towards greater sort of gold reserves in your central bank treasuries will keep increasing as such, right? So that is the rationale and the impact. So for you as me as investors, when we are investing, a couple of things to keep in mind, right? The first is gold as a part of your portfolio should be a core part, right? So typically 10 to 15% of your portfolio, if it is allocated to precious metals, gold, silver, and the like, that's typically a good allocation to give you some amount of stability through the market cycles as such, right? Second, be prepared for some near-term pain, right? So if you look at industries like jewelry, textiles, shrimps, organic chemicals, these guys have a good exposure to the US markets, right? So jewelry, for example, 40% of our exports go to the US. In textiles, that number is around 45%, 30% odd for shrimp, around 15% odd for organic chemicals, right? So in the near term, as this sort of plays out and there is uncertainty in these businesses, there will be some amount of pain, right? Because obviously, if your one of the key markets is out of the picture, your capex plans go down, your overall confidence in that industry goes down, and as investors, people get a bit dicey about those businesses as well, and they kind of take a hit as well, right? So these 4 or 5 industries, if you do not already have exposure to that, you can kind of avoid them for the interim. However, if they take a disproportionate hit, right, if they take a very, very sharp hit sometime in the future, that could potentially provide an opportunity because we know long term the amount of tariffs that we could apply on this industry are not at the levels that are currently applied. You cannot have 50%. Important to note that he can stretch it as much as he wants, right? He can say 50%, go to 100%, go to 200%. We know all of that is fluff, right? Eventually, he'll come down to 10 to 15%. So you know that even in these industries, even though the market might be a bit apprehensive, long term the numbers will be at around 10-15%, at which point it is still a hit to the businesses, but not something that cannot be borne as such, right? You can, the government can easily give enough kind of incentives to that industry to get it back on track as such, right? So these few industries will see near term pain, but medium to long term should be fine. Again, the country, as we kind of emerge from this, right? Obviously, the export hit will take a hit on our GDP growth as well, and as a government, we'll try to counter that by boosting domestic consumption, domestic growth plus government spends. So, any industries that can benefit from that, right? Your domestic consumption, rural consumption based industries, your banking infra sort of plays, your utility businesses, all of these businesses which are more kind of steady state businesses will kind of benefit at least short to medium term as such. And obviously on the allocation front, having some allocation to metals is always helpful, right? Over the long to medium term, I think the way India is positioning itself and increasingly all of the BRICS nations are positioning themselves is quite a sensible thing to do. Is that if you have a player who is negotiating very, very irrationally, it simply doesn't make sense to interact with that player at all, right? Let them do their chest thumping. When they come back to the table with a more kind of sensible offer, we can then kind of discuss that as such, right? So broadly, that is the length and breadth of it. Not too much to be worried about from a long-term point of view. India has been very, very strong. Despite what Mr. kind of Trump says, we are the largest growing, fastest growing large economy. Our contribution to global growth is now even ahead of the US, right? So a lot of introspection to be done by them. For us, we are growing well. We have got a fiscal situation under perfect control, right? So both on the government side as well as on the monetary side, we've been performing phenomenally, and that kind of explains the spread compression that we've seen vis-a-vis US bond yields, etc. So broadly, from an India perspective, long term, not too much to be worried about. If you are investing, continue to invest in a certain way. short term, some sectors could see stress, but as we said, right, over if you have a greater than 3 to 6 month out horizon, which you should have as an investor, this will not be a major or needle mover for us, right? So that is it for this video. We hope it added value, and if it did, please consider sharing it with your friends and other investors as such, right? Thank you so much. Thank you for your time.